Hey, this is Wasabi Boat Research, and I am talking today with Crypto Idealist. I have no idea how I ended up following you on Twitter, but somehow it happened and saw your tweets on the Curve, veCRV, Yearn, Convex finance situation that's going on. And these are protocols that I've been interested in, but I haven't been an investor in. I haven't had my money in these. So I haven't been super attentive. I find myself paying more attention to stuff where I have money naturally. But I think, I started looking at this and so many of the interesting building blocks of DeFi are kind of come into play here. So you have the idea of money Legos, one protocol building itself on top of another protocol and trying to incentivize money to flow this way or that, or trying to incentivize holding or not dumping of tokens. And then you have this idea of short-term gain, farming and dumping versus long-term, trying to build up a business that's going to last for dozens, hundreds of years, and how you kind of use financial incentives to push people one way or another. So this is probably the most fascinating story, and it's one that I really have no idea of the details of. So then Crypto Idealist, when I saw your thread on this, I said, why don't we get on the phone and just talk through it and go through everything. So thanks for talking to me today.
Hey Wasabi. Yeah, thanks for having me, brother. I'm glad we got connected, and I agree. I think it's a very nuanced and integral part of DeFi, the entire Curve ecosystem, and the Legos that kind of build on top and through it. I've spent a ton of time researching all of this, really an inordinate amount of time. I would say it's pretty much my niche in DeFi is the Curve ecosystem. So definitely not an expert, and definitely don't understand the math as well as someone like Charlie or the guys who started Curve, if you saw that recent white paper. But I'm happy to talk about it and excited for it. Thanks for having me.
So before we get into that, I know you're anonymous on Twitter, so not dox yourself. But how did you get into crypto? How did you find yourself in these protocols, and what have you been doing the last few months to kind of like become comfortable enough where you can kind of go big into these?
Sure. So I got into crypto well, I first heard of crypto back in 2013. And of course, hindsight, we can always have regret. But I was going to a music festival and I was picking up a friend. I just met this guy on Reddit, actually. My friends and I, we were looking on Reddit for the music festival, and somebody said, hey, I need a ride. It was on our way, so we decided to pick this guy up. We stopped by his house, and he brings us up to his room and shows us his computer where he's mining Bitcoin. And he tells us all about it, and I think I just wasn't in really a money-making phase of my life. I was going to college, I was excited to do that whole thing, and so I kind of just shrugged it off. But I saw a man mining Bitcoin in 2013, a 16-year-old. And of course, 4 years later, in 2017, he had such a great time. He started biking around the country, and he lives a completely free life now. I have no idea how much he made on it, but he does whatever the heck he wants all the time, and I'm really happy for him. It's a beautiful thing. But I got into crypto back in 2017. I was working real estate. I was doing about 70, 80 hours a week in real estate for 2.5 years. That was my hustle. And so I didn't get to pay as much attention to this as I might have. But I had a really good friend who was, and we were roommates for a while. And so I saw him just staring at the charts all day, every day. And I would just ask him questions because I was just curious what he's doing, why he's spending so much time on this, and what's going on. And he was trading Ethereum in 2017. And so I started learning. And then through working those 78-hour weeks for the next couple of years, I would still kind of pay a little bit of attention to crypto. Then, let's see, it may have been about 2019, I stopped doing real estate. And one of the first things I started doing was day trading crypto. And that only lasted a few months because honestly, I wasn't able to handle the stress at the time. But it was a good primer because then later that year, I'd read the Chainlink white paper and have my mind blown. That was the moment that I fully realized this would undeniably change the world. And basically, Just seeing the mechanics behind how a decentralized pool of actors could operate in a trustless way to verify real-world data and make it immutable on chain. That helped me believe that all the real-world applications envisioned, mostly in the 2017 hype, were actually possible to be executed in a trustless, decentralized manner. So I got into Chainlink at about $4 right then at the beginning of 2019, and I held up until mid 2020 when crypto again started to get my attention. So I ended up selling Chainlink at $17. I had an easy 4x there. And then I had a friend who I'd been following for years on health topics start talking about crypto. And I had the courage to join his paid group. And at that time, it was a large portion of the money I had over the course of the year just to join this paid group. But because of that paid group, I found Urine at $12,000 and put all my Chainlink monies into there. Rode Urine up to 40,000, sold it mostly there. Then I kind of got greedy and used Aave to make leverage and got liquidated a bit on the way down. But through all that, I got to participate in DeFi Summer. And because of that, I had a great primer to then come back into crypto in about December of 2020, this last year, and then go full time and all day, every day, just be in this space and participating.
Do you see yourself as more of still kind of doing a lot of trading in and out of stuff, or are you now more kind of buy and hold, or what do you think about in terms of like your time horizon?
Yeah, I always I knew I didn't start with a whole lot of funds, and I was living off of, after I stopped doing real estate, I was living on what I had in savings. So I took a portion of that, and I decided I would play very risky, and I was doing the day trading. Then I held Link. Then I did a bit more day trading through DeFi Summer. Then I kind of just was out for a bit. Then starting this year, certainly a lot of in and out. And that was because I started with relatively low funds, and I knew I had my targets, and I knew to get there I needed to play risky. But now that I've gotten a bit further down the road, I started getting to a point where, and I always knew Curve would be my backup plan. As I made money, I intended to take more and more out into Curve and farming safely on Curve. And so that's been my plan. And then when Convex popped up, it was a great opportunity for me to say, hey, this is the time. Not only can I safe farm Curve, but I can do it in a way that's actually providing me a great return. And so now I'm mostly passive, but I've taken a portion of my portfolio, about 20%, and I'm still playing with that.
Okay, so you brought up Curve, and so let's kind of transition into the main topic that we're going to talk about today. So we're talking about the interplay of these three protocols: Curve, Yearn, and Convex. So Curve, I'll give you like my kindergarten level understanding is that you've got tokens and you've got stable coins, mainly US dollar, euro, or other ones, newer ones that are kind of pegged to volatile assets, and you're trading them, and you can either go to a place like Uniswap or SUSHI and they're using the XY equals K formula to do pricing of the tokens when you're swapping, or you can go to somewhere like Curve, which has a different mechanism for providing liquidity, and it's kind of more optimized around things that are like 99 cent to $1 to $1.01, or kind of like very tightly in that range near exact peg. Is that have I got that right, or is there kind of deeper story that I'm missing here?
There's definitely a deeper story, but I think that you've got a general gist of it there. Curve is it is a AMM, so it's an automated market maker. It's a decentralized exchange, just like SushiSwap and Uniswap. The main differentiating factor being some of their math and the behind the scenes of how their pools work, but also that they're mainly focused on stablecoins. So kind of like you might go to a store specifically that sells clothing to buy clothes, but you could buy clothes at Walmart. That's a convenience store for everything. So in a similar way, Uniswap and SushiSwap have kind of taken more of the convenience store route where they have all the assets. And then something like Curve says, hey, we're only going to do stablecoins, which are more or less pegged to the dollar, or other types of peg assets like derivatives of Bitcoin. so different derivative products. Um, and so they've really hyper focused in on this niche, and because of that, they have an incredible amount of liquidity for those assets. So much so that it is much better for traders to trade on Curve for stablecoins, especially in size. And we can talk about that and how liquidity pools work. That's something I had planned for later down the road, but wherever you want to go with it.
And is when you're providing liquidity to Curve, it's also different in that you can just provide one asset, right? Like you don't have to provide a 50-50 mix, or is it work some other way?
Yes, so you just provide the asset that you want to provide. So if you're in the three pool, you could provide DAI, you could provide USDC or USDT. And so that gives people a lot of flexibility for what they're able to do and how they're able to use their assets, and not demanding that people be in one thing or the other. And that's very important for stablecoins as well, because with stablecoins, they all run on different models. And you would say, well, why do we have all these different stablecoins? Why can't we just have one that makes sense? Well, that's decentralization. And the fact that they maintain their peg in different ways. You have custodial stablecoins, and then you have algorithmic stablecoins. Custodial stablecoins say, you give us $1, we'll give you one of our stablecoins. And we hold that dollar, and that way, if you ever wanted to give that stablecoin back to us, we've got your dollar to give it back. And so that's how they maintain their dollar peg, essentially. And then you have algorithmic stablecoins, which say, well, we might do some combination of that, but essentially we maintain the peg through a series of incentives that incentivize buyers and sellers to arbitrage and to keep this at the dollar amount. And the benefits of that are that when it's decentralized and algorithmic, there's no source that you need to trust other than the code. And that's the ethos of crypto in general, I think, is cutting out the middleman and just trusting code. Whereas with these custodial coins, you have to trust that Tether is holding your dollars and not rehypothecating them, which they are. And you have to trust that someone like USDC is doing things in a way that's not going to be at risk of a government agency or someone like that coming in and saying, hey, you are issuing a security here and we need to shut you down or otherwise regulate you. So there are risks that come in with that custodial nature of something. And so that's what I think the algorithmics have some benefits there.
Yeah. So I think we were talking before about our experience with algorithmic stablecoins, and it's almost like kind of like a running joke now on Twitter. Like they're in this kind of phase of hyper innovation and development and trying to figure out a model that works. And there are models that are kind of pure algorithmic where there's no backing with assets at all. There's, like the maker model where you're putting ETH or other assets in behind it at a over collateralized and minting it that way. But then, Frax, where there's like a pool of US dollars in it, and that's kind of going down as the algorithm gets better and better at working. So how would you look at kind of like the different risk levels, or like each stablecoin kind of has its own risk profile? How do you think about, if you were to kind of rank them from riskiest to least risky, how do you think about doing that?
Yeah, it's a really personal question, honestly. And I think that's why Curve exists to a degree in the way that it does, and having all these pools for all these different stablecoins and letting people kind of arbitrage between them. Because I think that we're such in the early stages of this playing out, but in reality, there's no reason that our stablecoins need to peg to the US dollar per se. I think that we're moving more towards a future where we have, and you see protocols like Bank, Float, or Bank, and a few others who are kind of just creating a floating peg. And I know Ohm and all the Ohmies are doing that as well there. And so they're kind of doing this more on like, let's have a unit of account that equals 1 or some other value, and that just be the unit of account, not that necessarily equals $1. And that's important because if you believe that the dollar's inflating or losing its value, well, then it might be a scenario where you actually need multiple dollars to get a unit of account 1 in crypto. And so I think that's more of where we're headed. And so everyone's kind of gaming this out right now and battle testing different theories, and it's really a hodgepodge of who's going to win and a toss up. Personally, I'm a big fan of liquidity. I think that with ETH and July 14th, the London update potentially moving us more towards deflationary model and ETH being a better store of value, in addition to being programmatic money, I think that liquidity and using ETH as collateral for their stablecoin really kind of makes a lot of sense. As well as when you hear the founder talk and outline some of the ways liquidity works, and you can look into the documentation too. It's they have very well designed mechanisms for keeping peg. And making sure that the investors who are essentially buying in to keep the peg do not lose their funds. And protocols like ESD and DSD and that more on the risky end for sure. Because I don't know that we should get into that. I think that it's very personal, and you should look into these things and see how they're working, and if they're incentivizing greed or if they're incentivizing actual utility and using some form of over collateralization with liquidation mechanisms in place to ensure that no one's funds are lost.
And there has never been, to your knowledge, any event where any of these assets that are in Curve has significantly broken peg. Is that right? Like they're, from what I understand, like they're super conservative about which assets they pick to go into these pools. Is that
Yes. As far as I know, nothing has happened, and I feel like I would have heard about it. With the Euros, there's actually some talk right now that there might be something to happen with the Euros pool. I haven't looked too deeply into that to know exactly what, but somebody I was reading that in certain areas. But again, that pool is just euros to S euros, so it wouldn't affect any other liquidity, and that's another reason why this is so well designed, because when they do take risks, they often do it in a way that doesn't put it limits the risk to just that singular pool, and things are traded in a way that like for instance, we've got ETH ETH pool, right? So like in that pool, the risk is between those two assets, which are theoretically pegged to each other. But something happens with one of those, you're not impacting USDC, USDT, or any of the other pools on Curve. So they've kind of segmented this out in a way.
All right, so let's take it from here. So I've got 100K US dollars sitting in my bank account, and I'm earning 0.001% or some negligible amount of money. And I heard about this thing Curve, and I can get these juicy APYs on these kind of weird looking dollar things. So why would I want to jump over and put my money on Coinbase and then take it out onto my ledger and then plug it into Curve? What's going on there, and what's in it for just a random person that has US dollars?
Well, like you said, the biggest advantage would be the higher returns that you're able to get on your money. So you can convert your US dollars that you're earning less than 1% on at your bank, and you can convert them to a crypto stablecoin, either one of the algorithmic or custodial ones we talked about earlier. You can deposit it to a pool on Curve, which is essentially a place where people exchange different stablecoins for each other. And for your providing what is essentially, you're giving water to the buckets that people then go and move water from one bucket to the other bucket. Like that's how this trading works. There's two buckets and representing two different assets, and those are the pools. And so when you give money to one of those pools, you are adding a level to that bucket. And then somebody can go in there and scoop one from one, take that, and give to the other bucket, and they can use the liquidity you provided to trade. So for doing that, you earn a portion of the fees. And that's where the APYs are coming from here. And even just that, the trading fees themselves are going to be higher than the bank that you'd be getting that money sitting in the bank. Looking at Curve right now, we've got like 5%, anywhere from 0.5 to 5% as a base fee. And then on top of that, you're going to be earning CRV, which is their native token. So that'll boost the reward up to anywhere between 10 and even I see some on here that are 40%, as high as 40% on stablecoins. So something that theoretically doesn't change in value at all. You have no volatility risk, and you're earning up to 40% on that asset.
So the base APY, the rewards are given to you in whatever asset you're contributing to the pool. So that's component one, and then component two is the CRV rewards on top of that,
Um,
right?
Actually, I'm fairly certain. So some of these pools incentivize with the token that you're providing. So for example, Alchemics, you give to that pool, they're gonna give you some ALUSD as a reward. But the base APY is, as far as I understand, is paid in 3 CRV. So that is kind of Curve's representative of it's a stablecoin itself, which is a representative of the trading fees. So all trading fees are paid out in 3 CRV.
And one of the things that really kind of attracted me about Curve was this ultra long time horizon they have. So can you kind of set us up like, if you've jumped into any like DeFi farming, you'll see things like, we've got this 2 week liquidity mining or a 22 week or a 6 months or something. But Curve, correct me if I'm wrong, but their time horizon is something like 300 years. So how does that how is that designed? What are the incentives that they're trying to set up with this 300-year
Sure.
time horizon?
So with Curve, I think it's very intriguing because they're trying to play one of the longest term games in crypto. And this is actually not too different than Sushi Swap or Uniswap. Sushi Swap and Uniswap also have theoretically infinite inflation. And this is very different from most DeFi protocols where there is a hard cap on the asset. And when you look in CoinGecko or CoinMarketCap or wherever you're exploring tokens, you may see a max supply number there, and that can be misleading because it doesn't actually always mean that that is the max supply or that there even is one. So you do have to look deeper into these protocols, read their documentations and things like that. But with SushiSwap, Uniswap, and Curve, or with SushiSwap and Uniswap, they have infinite inflation. They have a plan for that, though it seems like a little bit more flexible than Curves, which is do have a hard cap, but we're going to get to it in about 300 years. And this is the math for how that works out. And so that makes it a very logical decision when you look at that and you want to be involved in it, um, to decide how you want to be involved and how you value that thing. And so when you have a protocol like most of these farms that we're looking at, including Convex, by the way, that essentially will have all of their supply released in maybe 3 to 5 years, that's a situation where then rewards are going to dry up at a point, these additional rewards that are being paid out. So for Curve, we said you deposit and you get paid in the base fee, and then you also get paid in CRV. Well, you can be sure you're going to also get paid in CRV for about 300 years. So that is additional reward for something like Convex, actually, which I still am very big on. That those rewards of their CVX token will dry up at a point, and what that will essentially do is incentivize competition. So for most of these DeFi protocols, I think that they have a very short time horizon. In a sense, they'll go for however many years their inflation goes, and as the inflation gets close to being capped out, you'll probably see a scenario where a competitor arises, offers an entirely new inflative governance token, and just takes most of the liquidity over. And that's a situation that you actually can't have really happen with Curve, not only because of the 300 years that their supply is inflating, but because of the lockup mechanisms. And so that's something we could get into if you want to talk about that now.
Yeah, one more question on that. So like these base APYs of, 0.5% to 3 to 5%, that's kind of a function of the people being willing to trade on Curve and pay those fees, right? So like, is there a moat in terms of could a competitor come along and charge a lower fee and kind of suck up the liquidity from Curve, or if that happens, then is it just the supply and demand to trade at a certain fee structure that's kind of driving the usage of
Yeah,
Curve now?
I think what you're describing is like the theoretical race to the bottom that some people describe on fees, where if your advertising factor is primarily that you have low fees, well, then somebody else could come out and just advertise lower fees. But the reality in crypto and why it's so cool with these decentralized systems is those fees aren't just a company deciding that they want to charge lower fees. For us, this is actual users who are providing liquidity to these systems deciding what fee is acceptable for them to be involved. So the way I would see it is if someone came out and tried to basically create Curve with lower fees, you might have some liquidity go over there to play that game and earn their native token, call it ZZZ, right? But I think that most people would say, well, we could go and do that, but we know that as the inflation of ZZZ wears on, I'll just be earning this smaller fee as the base APY, and I can earn a higher fee over at Curve. So I think that the market kind of decides, right? The market decides what is an acceptable fee. And also the interesting thing with Curve is not even getting into the lockups and things like that, but this is all decentralized governance, and Curve is one of the best in terms of how actually decentralized governing they are. So what will happen is if it does become a scenario where a competitor comes out with lower fees and the liquidity providers on Curve say, hey, we're okay with lowering our fees, and a majority of them are willing to do that, then the protocol actually can be changed as far as I understand for lower fees. I would have to confirm that, but from my understanding of the system, if governance decided we want to charge less fees, they could do so through either direct or creative means. And so I think that's what gives Curve the flexibility against competitors doing that. But ultimately, it's the liquidity providers who decide what are we willing to lock our capital up for. And if you go too low on that number, they won't lock their liquidity up.
Okay, so why don't we get into the locking of the CRV token? So from what I understand, Curve, says, hey, we're going to reward you with the CRV token, and a lot of people were depositing in Curve, getting the CRV token, and then immediately selling it to just put more back into the underlying pool or do what else with it. So that kind of created a problem, as so many of these yield farming projects have, of their native token getting dumped, right? So how did they deal with this problem? What was the mechanism that they came up with?
So yeah, that is the main problem. If you give your native token as rewards, and that's a significant portion of the APY, well, a rational actor says, I sell that reward and get that APY while I'm sure that I have it. So you need some sort of value accrual mechanism to your native token so that you essentially back it by something more real. So what several protocols have done is they've done that in the terms of dividends. So you get a portion of the trading fees. For instance, with Curve, that is actually one of the mechanisms. So half of the trading fees actually go to the liquidity providers who are providing liquidity to these pools. The other half goes to people who stake CRV. So on a base level, that is providing right now about a 10%. It fluctuates between about 10 and 15% APY just to stake CRV and earn those trading fees. So that is one level of it. And a lot of protocols will do something similar to that. The difference with Curve is when you stake with them, you stake for a period of 1, 2, or 4 years. So obviously that's a lot of time to commit something that, especially a volatile asset. You're committing staking CRV, which you then have volatility risk on, for what is right now a 10-15% APY that could be changing. So that is a trade-off that someone could make, and to further incentivize that, they've done something else, which is to say, on Curve, when you provide liquidity, you earn the base APY on the trading fees. Then you earn CRV rewards, which is a share of the inflation. The CRV rewards that you earn can be boosted up to 2.5 times. So I'm looking at the 3 pool right now, and the CRV, the base APY is 0.63%. That's just off the fees for that pool. The CRV inflationary rewards are 3%. Now, if you are to lock up CRV for 4 years, and there's a math equation to figure out how much you need to lock up, but I've worked it out, and it's essentially the amount that you want to farm with. So if you're farming with $10,000, you lock $10,000 of CRV, and it fluctuates, so don't hold me on that. But if you were to lock up that CRV for 4 years, now that APY and CRV rewards goes from 3% to 7.5%. So in addition to locking up CRV and making trading fee rewards at about 10 to 15%, you also boost your yield within the liquidity pools. So this really incentivizes actors who want to do both. In a sense, want to provide liquidity to the platform and help the platform stabilize long term by staking these coins for a long period of time.
Got it. So they've set up this incentive to boost your APY for the stable coins or whatever you're putting in on the base layer up to 2.5 times by locking up the CRV for multiple years, right? And so you have to do an increment. It's like weeks, right? Like you can pick how many weeks you're locking it. Is that right?
My understanding was it was 1, 2, or 4 years. As like just flat amount of times that you could do. There might be a way to just do the weeks, though. I don't know that for sure. But 4 years provides the maximum amount of benefit. So if you lock up for 4 years, you're getting more benefit on the boost up to 2.5 times than you would if you just locked up for a year.
Okay, so all of these dynamics, the yield boosting for if you're in there for 4 years, creates this kind of market opportunity for other protocols to build on top of this, right? So I guess now we should kind of get into Yearn. So when was Yearn launched, and how does it kind of interplay with Curve?
Sure. So Yearn launched in DeFi summer last year. So this was about, I believe it was July that they officially launched. It may have been June or July. And essentially what Yearn did that was genius is they said, well, this is a great system Curve has designed, but we understand some people are going to want to just farm stablecoins, and some people might actually want to take on the volatility risk of CRV. And personally, me, I'm in the category where I'm fine to take on the volatility risk of CRV. I think that's going to be a good bet for me long term. But I could understand how many people would look at this and say, that just doesn't make sense for my business model. I just want to provide something that's stable, non-volatile asset and get a return on that for helping Curve do swaps. So cool. So what Urine said is we will match those two people together. The people who want to just provide CRV and stake it and take on that volatility risk, but also get the gains of that. And then the people who just want to yield farm and provide stable coins. And we'll match those two people together, and that way everyone makes the most they can make while also taking on the risk that they want to risk. And they set up their incentives so it makes sense that people do that, do both sides of that. And that's not all they do. Yearn is essentially a DeFi hedge fund. So they have plenty of strategies that arise from their community. And this is one of the coolest parts about community governance is they're multi-sig, the people who essentially control the code and what happens, were people that arise, like Banteg, that arise from the community itself. And people just said, this is someone who's saying good things and we like the direction they might take the protocol. We're going to give them the power to do X, Y, Z. And then anyone from the community can come up with a strategy to acquire yield, whether it's plugging into Curve or plugging in somewhere else. And if the community likes that strategy, it's implemented, and then people can decide to be a part of that with their capital or not. So it's a DeFi hedge fund in the sense that it invests across the entirety of crypto, and it's still very much in the hands of its users and its owners. And they also did a hard cap supply that be reached within, I believe it was a month. It got reached. The Wi-Fi supply. So this was very underground at the time, so it wasn't farmed by, Alameda and SBF weren't dumping 500 million or $1 billion into it to farm up as much of the supply as they could. This was a kind of grassroots starting where there were a lot of participants who farmed this thing for a month, and so the supply got very well distributed And that created a system where there weren't too many dominant players. And so, in addition to all the DeFi hedge fund stuff they do, their primary strategy has been CRV, and now they've actually scaled it back. It's as far as I understand from the stats that I've seen, it's about 42% of their entire strategy. But essentially, they're matching people who want to lock CRV and people who just want to farm it.
Yeah, it's interesting. I mean, I had when I was introduced to Yearn also last summer, DeFi summer, like the concept that made sense to me was, like you said, the hedge fund, right? So I have assets in this token. I want to put them in, and I know that there are all these crazy yield farms everywhere, but I've got a job. I don't have time to be farming and compounding or reinvesting, or I don't necessarily have the money in gas. It wouldn't make sense for me to do all these Ethereum transactions when gas is crazy. So why not put it together in this big pool and have the pool kind of in an algorithmic way do these transactions for me, right? And they're taking a fee off of that, right? So it's like we're going to find the best opportunities in DeFi for you for this asset and do it for you in exchange for a cut, right? So, but then when I looked at the Yearn homepage, you know, their headline, and in my kind of non-crypto world, I do a lot of copywriting and kind of like financial copywriting and stuff. So like their headline has always been maximize your CRV rewards. So it just struck me as a little bit strange that it's not like grow your money, you know, get 10% a year, get 20% a year, that it's based on this other protocol, right? So and my question that I had for you is like how much of Yearn is connected to CRV, and I think you answered it earlier, so it's 42%. So I guess, would you say that's kind of trending downward as they branch out into these other, like they're doing Link, they're doing WBTC, they're doing these other farms that have come out now, so, or other pools that have come out now. So would you say that the curve importance is going down, or is it still really critical to their business?
You know, it's a really interesting point, and it's something Benteg's been talking a lot about. One of the lead devs and community spokespeople is talking a lot about on Twitter lately. And you're right. I just went to the Urine page myself, and it still has that maximize your CFV rewards. It's really a marketing thing, I think, because when they started, that was a very attractive narrative to say that we're a DeFi hedge fund, and more like what you said. You know, if you want to just passively invest your money and not have to worry about moving it around all the time, we'll do that for you, and we'll take a fee for it. But what we kind of found after the Yearn pumped to 40,000 and then it fell and it was just kind of flat for a very long time, was that actually there's not so much of a demand for that right now because there are so many people in crypto that actually are fine to actively manage their funds because they see that they could yield more returns that way, at least just because they don't have to pay Yearn a fee. If not, that they're willing to go into more risky things that Yearn doesn't do. So now that Curve has really been kind of taking off into the narrative, I think that on one hand, Yearn highlighting the degree to which they're maximizing your CRV rewards, what they say on the first page, is a good strategy because everyone's very much talking about Curve right now. They're also trying to say that we do all this other stuff as well as new participants enter the market. As you have Mark Cuban, last night just posting a blog post talking about how DeFi is going to could change business forever. And so we always anticipate more and more institutions and more traditional finance people getting involved. And to them, I think something like Urine is very attractive. A DeFi hedge fund where they don't have to worry as much about actively managing their funds. And also something like CRV is very attractive, itself. Just let me deposit stablecoins, not have the volatility risk of what is the most volatile ecosystem in all of the world in finance, in that crypto, and still make DeFi yields. So does that answer your question?
Yeah, no, it does. The next point I kind of want to understand is this relation, like, DeFi, money Legos, these two protocols are fitting together, but oftentimes it's not a win-win, right? Like if my protocol is farming and dumping your protocol, that's not, you don't like that, right? So what is the current state, or is it kind of different vault by vault? Like, what is Yearn doing there? Are they contributing to locking more of the CRV, or are they some strategies still dumping it, or how does that work, and how is like the relationship between them evolving?
Sure. They have a percent. I don't know it off the top of my head, but they have a percent that they use of the earnings to buy back CRV and lock it, and that benefits everyone who's in the pool because they get increased rewards for locking more CRV. And then the rest of it is sold for more, essentially dumping CRV. And so that's something that Urine has been accused of, and Farm has been accused of, is essentially vampiring a little bit other platforms because they're just dumping and providing a massive amount of sell pressure. I think that the narrative is starting to change now with Convex. Convex has kind of forced the issue here. And I would anticipate Urine to start incentivizing more and more lockups, because the stats show, when you see, DeFi Moon is one of the people on Twitter I look at too for a lot of the stats, and you could just see how Convex is locking up CRV at an incredible astronomical rate. And I know we haven't gotten to Convex yet, but this is kind of puts in context Yearn. Yearn locked up about 16 million CRV over the last almost year now.
So they do a bit of both, right? They do some dumping and they do some locking, and it's kind of basically strategy by strategy, right?
Correct.
And so then the other point to know is that, like you mentioned, they did kind of like a very quick token emission last summer, and that's basically done, right? Like they're not emitting more YFI tokens. That was part of their narrative. Like there's only a certain amount, and that's done, right?
Yeah, they chose a different model. So instead of like you said, instead of issuing Wi-Fi for 300 years or something like that, right? They issued it over the course of a month, and they're using the performance fees of what they generate through Yearn to buy back Wi-Fi, which essentially gives value to all the people. Theoretically, gives value to everyone who's using Yearn. So it's a different model, yeah.
But it's not a token that they're issuing as a reward, right?
No.
So
no.
like,
yeah,
in some sense, that's where the Convex comes into play, right? Because other protocols can use their tokens as kind of like this currency to pay out to incentivize their use, right? So that's, I think,
exactly
a good point to bring up Convex, which is this new protocol that's launched in the last couple months. So
it's just been a month and a half. Maybe just a month now. I think it was around mid-May. Yeah.
Yeah, I know. DeFi. It's like, we were supposed to talk last week.
Feels like forever.
And it got pushed back, and then like 10 new things have happened. So that's why I like to have these conversations. I like to kind of slow things down and think about like the protocols that are going to be around in 10, 50, 300 years. I mean, like, we're talking about at the beginning, like just general like trading strategies. Like I think in the last year I've become convinced that like this space is not going to go anywhere. This is going to be, like we were talking about, like this is going to be the new financial system, or this is going to be a significant part of it. And so you don't need to be right that many times to have like life-changing investments in that kind of space, right? Like it's kind of more about taking time to understand these things deeply and thinking on a long-term horizon, because it's like there's no other space. I know it's, you sound like you're in the US, but like, I can't just like roll up and make a venture investment unless I'm an accredited investor. So unless you're in DeFi, right? Unless you're in the space where you can find the next Amazon and, buy into it the weekend that it launches. So 6 weeks ago, Convex launches. They are also kind of built on top of CRV. How are they positioning themselves against the CRV and Urine dynamic?
So kind of similar. I know we talked earlier, SUSHI and Uniswap kind of taking that convenience store approach where we do everything, and then Curve saying we just do swaps of stablecoins. In a similar way, Yearn is the DeFi hedge fund, right, that now does only 42% of their strategy CRV farming. Convex says we're all in. All we do is CRV farming. That's what we are. And the benefit of that, which you alluded to, is that they have a token, their native token CVX, that they can give as an additional reward to incentivize lockup of CRV and people putting their liquidity or plugging into Curve through Convex. And so this actually illustrates the point we made earlier too of why it's so important that Curve has a 300-year inflation tail, and why most of these protocols that exist right now are probably going to get beaten out, is because they only have the 4 or 5 years on their inflation tails. And then what happens when your inflation's all done? The rewards dry up and a competitor comes out. And that's exactly kind of what happened here with Urine and Convex. Urine doesn't have Wi-Fi to give out as a reward because they farmed it all so quickly. So it incentivized Convex to pop up and do essentially the same thing within the domain of CRV farming, but have additional rewards that they can issue. So so it's essentially the same thing where Convex says, we understand some people just want to farm through Curve with stable assets. Some people want to take on the volatility risk of CRV and lock it up for a determined period of time. And we'll match those two people together. And making the incentives work well enough that everyone's happy to be a part of that system.
What did they do to grow so quickly? Like, how they seem to have come out of nowhere and suddenly they're locking faster than YFI. Like, how did they manage to scoop up so much liquidity so fast?
Yeah, it was a bit of two things. One being, like I said, that they have additional rewards to give, and we can get deeper into that. The other part of it is that it was the right time. I mean, it was perfect timing. The market, I can look, but I know it was around mid-May when everything started trending down, when we went down to 2K ETH for a moment, and I think it even a little under for a second. So everything was very fearful, and Convex is released. And so in one aspect, anything that's released when everything else is going down kind of has that advantage of being, well, we're new, and then people start putting their money there because it's the one thing going up while everything else is going down. And so I've seen that in several assets actually that I've invested in over the last month, who are taking advantage of that exact principle. And then the other part of it is, if Curve and CRV farming stablecoins is the safest thing you can do because there's no volatility risk on those stablecoins, well, it's the perfect place you want to be if the market is trending down, or if people are fearful. Because when people are fearful, then it makes sense. Let me get in stablecoins. Let me get in something that's non-volatile, theoretically, and I can make a good APY on it. So it was perfect timing for this thing to be released that also had the benefits of saying, well, now we're going to issue our CVX, where the only other place you could do this, Yearn, has no additional rewards to issue. So now it's adding another layer on top of it, of Curve, essentially creating a user interface for people to use Curve.
Well, you said they're creating a user interface on top of Curve, and that's one thing in DeFi. Like, I'm not a coder, but if I was, this is the area that I would be building stuff in, because I think, kind of a side note, but like vfat.tools, like this farming calculator, I think that's like the ultimate interface, right? It's like providing a front end to not just one farm, but like all the new farms. So it's like a combination of kind of like discovery of the new projects and also then doing the transactions directly from there. And
ideally, like you would have a combination of something like Zapper and vFat. Like, that would be the dream. Like, if you could have a Zapper UI interface, which is just beautiful and very well done, that anyone could go on there and relatively easily understand what they're doing and plug themselves into where they want to go. And then something like vFat, which is much more guerrilla in its appearances and function, but it's got everything that's, it's the most on top of it. What's the new farm? Where is it at? Where are all the potential yields and values? Where it's got the best data for sure of anywhere for farm data.
So, okay, to get back to like the Urine Convex thing. So Convex is sucked up the liquidity because they're kind of this easy to use interface, and they have this additional reward of their native token that they're giving out, right? So then, I've
Mm-hmm.
seen like Blue Kirby, I've seen other people tweeting out that, there's this kind of race between Yearn and Convex to lock up more CRV. But like, is is
Yeah.
this or is this not a zero sum game? And could there be kind of like a two winner? Could this be like a Coke and Pepsi situation, or is this are the dynamics something where like one is kind of like by the nature of the game going to become dominant?
It's definitely going to be multiplayer game. And that's the ideal too, because that's crypto, decentralized. Don't have a single point of failure, don't have a single point of entry. So I don't think it's a zero sum game. I think that Yearn's going to be a big player in this. I think that Convex is going to be a big player in this. I think that there's going to be a C, D, and E option that will pop up over the next 3 to 5 years. Um, that will also have a part in this. And the reason being is essentially what's happening is there's a race to lock up CRV. And that's not to say Convex won't be number one and they won't have a huge share of the market. Yearn be number two, and then a three, four, and five, and it'll look like something like a 30, 20, 10, 10, 10 distribution or something like that of the total CRV farming. But when you have systems like this, as far as I see it, there's no incentive for me now to lock up on Curve natively. As long as I'm okay with the additional smart contract risk and the additional layer of that, the incentives are such that it most makes sense for me to go through something like Convex or Yearn. Um, and the reason I think there's going to be a C, D, and E player is the same principle that what Convex has done to Yearn will happen to Convex. So when Convex CVX rewards start drying up, uh, it will make sense that a new competitor arises that says we now have a completely new schedule of inflation. And so essentially what's happening is these native tokens are buying locked up CRV. And the very valuable point to note that I don't think everyone's aware of is that the CRV that you lock up with Yearn and Convex are locked up forever. So no 1, 2, or 4 year lock and curve. A forever lock and curve is set by the smart contracts for those platforms. So the CRV that Convex has, which I believe I did the math and it's 1% already of all the curve that will ever be issued over the 300 years. 1% of all the curve that will ever be issued is already locked up forever on Convex. So at least all of the trading that Curve does in perpetuity, 1% of it will be flowing through Convex, which is huge. At the very least, they'll get 1%.
And so Convex, by giving you this one-time reward, they're able to get that 4-year max lockup in perpetuity. So it seems like they're getting a really good deal from this side of the equation, right? Like if their time span is on the hundreds of years, then that's an incredible deal for them.
Yeah, yeah, an incredible deal, and for Urine as well, because theirs is locked up forever too, right? So for anyone who's playing this game, and then both of them have a mechanism where a percentage of the performance fees from their earnings are going back to lock up more CRV. So there are mechanisms where even if there wasn't CVX being issued anymore, right, there would still be the performance fee on both of the cvxCRV pool and the CVX pool, which is 10% and 5% respectively of all the income that Convex makes. And a portion of that is used to buy back CRV and lock it as cvxCRV. And then that's paid to the people who lock up CVX. So that got a little hairy there, I feel. But essentially, when you lock CVX, the rewards are paid in cvxCRV. And that is the performance fee that's being used to buy back or buy CRV and lock it, essentially. So that is a mechanism by which even if there wasn't any CVX being locked anymore, because Convex has however much they have by the time that their rewards end, however much CRV they have locked, that essentially gives them a moat forever of liquidity that makes sense to be on Convex, as long as Curve is still a thing. So that's the base layer assumption, is that Curve is this forever 300-year protocol. And if you believe that, Convex will always have at least that 1% share of the liquidity. And right now it's much higher because all of CRV is not issued. And because of that, there will always be a performance fee. And because of that, there will always be additional CRV being locked by Convex. So in that sense, it is not a winner take all game, but there's definitely benefits to whoever's leading. But it's a race to lock up CRV while your inflationary rewards remain there. And that's what I don't think YFI has any advantage in incentivizing more lockup.
What percentage does YFI have?
Uh, Given that it's about half of like Wi-Fi has about 15 million, Convex has about 35. It's changed a little bit in the past week, so those numbers aren't quite accurate. But let's say it's that. So Convex has 1% then of the total 300 million curve that will ever exist. I think it's around 300 million. So they have about 1%. Urine has about 0.5% then of all the CRV that will ever exist. And then currently, let's see, CRV. Currently, there's 332 million CRV, and the total CRV is it says on CoinMarketCap and CoinGecko 1.5 billion, but that's not actually correct. Again, you have to look deeper into these protocols and look at the documentation. But it's actually 3 billion, around 3 billion, I believe. So Convex has 1% locked up right now, and Urine has about 0.5%.
Okay, so before we get off convex and curve, like one question I had was, so like today there's a finite amount of CRV that that is available for anyone to get, right? And so consequently that there's a finite amount of stable coins on curve that could achieve max boost, right?
Yes.
So does that in some way like limit the growth of curve? Like, is the growth of curve going to track along this curve token issuance, or how does that? In that sense, it is kind of zero sum, right? So like today, there's a certain number of CRV that are issued, and those can either go to Urine, Convex, or anything else, right? And so like on any given day, it is a zero sum game, both in terms of how much max rewards can be gotten on curve and who can get those rewards of these other protocols or users, right?
Right. And the inflation is decreasing too. So in August, it goes down. The next year it goes down. The year after that it goes down, and that's how they maintain this for 300 years. Is the inflation rate goes down every year. So yeah, there's an increasingly smaller amount of CRV available to boost yield. Whereas there's an increasing number of liquidity wanting boosted yield. So when you kind of math that out, as long as you think curve's going to grow in terms of volume and liquidity, which them adding volatile assets, which I know we'll get into, opens up the floodgates for more liquidity. So as long as you think liquidity is going to be coming more and more to CRV, what you would expect, unless CRV is being issued, you would expect CRV's price to just go up and up as more and more demand for locked CRV, as there's more and more demand. And then when that price goes up, when you game that out, now everyone's yields go up. Because if the yields are being paid out in CRV, there may be less that's being issued, but the less that's being issued is worth more. And so this is where, Curve is a very mathematical protocol. They've really designed this out so that everything balances very well. As the demand goes up for CRV, the price goes up, yield goes up, more liquidity comes chasing yield. Then as liquidity goes up, more demand for CRV, and it's a very reflexive kind of circular flywheel, as I've heard many people say on Twitter of late.
So Convex has 1% of this flywheel. Urine has about 0.5%. Do you see, are there any kind
Correct,
of glaring open, and because of that, they'll have this advantage going forward 300 years. Are there any kind of like market opportunities you see for someone to come and do even better? Or is it like kind of like a Coke and Pepsi, like these people already have their network set up all over and they're just kind of gonna squeeze out, they're big enough now that they can squeeze out new entrants?
No, I mean, because to think about it, like 1% and 0.5%, I mean, that's still very small, right? And they'll continue to grow, but I think the point being that they'll grow, Urine will grow as much as it can basically use its performance fees to buy and lock CRV. Convex will grow similarly, but mostly as long as it can incentivize more CRV lockup with its CVX issuance.
That 1% is like the 300-year pie. Like, what is the pie today? Like the slice. Like
Oh,
you
I
can
see what
think
you're
of two
saying.
different pies. Like
Yeah.
you can think of the 300-year pie, and you could think of the convex that's, or the curve that's issued on a given day, right? Like how much that, and that's like the 100% that you're fighting over. So what is that? So anyone who has
Yeah.
like a dominant of that share on a given day will be more likely to carry it forward into the
Well,
next
and
day,
think
and
about
so on
that
and so
too. Where
forth.
that's coming from is actually not from CRV locked up, but TVL. I mean, to a degree, it's influenced by the CRV locked up. It's a combination of how much CRV you have locked up and your TVL. So, Convex has it's been growing like 1 million a day, or 100 million in new liquidity to Convex every day. I think right now it's 3.7 billion. And the total value locked on Curve is 10.4 billion. So let's just say a third. So a third of all the liquidity in Curve is on Convex right now. So obviously the amount of boost impacts that, but theoretically you could say that's about a third of all the CRV issued every day going
And then
to Convex.
Urine would
About a
be
six,
about a six.
but
There, that
yeah,
ratio
but
stays
it's
like
it's
that.
influenced by the boost, and so that's where you've seen some graphics on Twitter lately that show Urine has a higher boost on some pools, and some of that turns out to be where they weight their CRV on what pools, but also because Urine they are using their 15 million for a much smaller number of or value of liquidity. Whereas Convex may have double the CRV locked of Yearn, but I believe it was like they have 9 times the TVL. So that CRV that's locked is spread across more TVL. And the only reason that makes sense right now is because of the CVX inflation. So again, so yes, it is a race for Convex to continue locking more and more CRV to guarantee the liquidity that they have now, even as CVX becomes less and less issued to buffer that.
Okay, so it does make sense, and I'm also thinking about like meme that I saw on Twitter. Like, there's this meme where there's like the guy talking into the woman's ear, and she looks like bored, and it's like,
Yeah,
so
yeah,
like
yeah.
I'm glad like I have this conversation now, so like I don't have to talk about this with my family or like random people who are not interested in this, right? So like now we're getting into the tokens, and this is like the part that kills my brain. So like I think probably like maybe the most useful thing to do would just be to like list all of the tokens that we're talking about, and if you could give just like a quick rundown of each one,
Yeah,
and then
okay.
what is like the utility of it, and like what do you think about, and I don't know how much you want to talk about like your individual investing or like your thesis on each one, or who it might be like what the preference is of someone who might be interested in one versus the other, right? Like, or if you think this, then you're going to want to be in this. If that's cool with you, we'll just kind of like go into like a quick breakdown of each of the tokens.
That sounds fun. Let's do it.
Okay, so we've talked about Curve CRV. That's their reward token. So that's going to be issued over 300 years. How many are issued per day? What's the utility? Is there any utility beyond just buying and locking, or buying and locking in either Yearn or Convex?
Okay, so essentially you're saying why would you buy and lock with Curve directly?
Yes. Or I think
Okay.
you've said that that's probably doesn't make sense because you could do it in Convex and get the extra rewards on top of it,
Yeah,
right?
yeah. I think with Convex, especially because Convex they just figured out how to get the EPS airdrops, so that's been one of the benefits of locking Curve, is that essentially those are the people talk about diamond hands. I mean that's the most diamond hands in crypto. If you're willing to lock a volatile asset for 4 years, so some new protocols have been coming out and airdropping CRV lockers their initial supply because they say, well, if these are the most diamond hands in crypto, then these are the people I want holding my token. So there was EPS, which is essentially Curve on Binance, and they launched and issue 25% of their supply, their total supply as it issues, to CRV lockers. And one of the problems that you encountered was if you're with Urine or Convex and you're depositing CRV, well, then you're not able to claim that EPS airdrop. And this is just one of the airdrops that's available. So Convex just fixed it. You still can't claim on Urine. I think that they just sell them to buy back, and so that does behoove everyone who's in it. But with Convex, you're able to now get those EPS rewards. They do distribute to your wallet specifically, so that's cool. So with that, then we say that locking Curve CRV with Curve the protocol provides a lot of benefits. However, it provides all of those benefits plus more locking it with Convex at the very least, and Urine as well to a degree. So to me, the only reason you would lock CRV on Curve the protocol natively is if you just simply do not want to take the additional layer of smart contract risk, as well as if you have some doubts that the peg can be maintained between your receipt token. Because, and I'm guessing that we'll get into this when we're listing tokens, but essentially, for every time you lock something, you get a receipt, and that receipt is a token. So I don't know if you want to wait until we get to the other tokens for that, but there's the additional layer of smart contract risk and your the ability of the peg for your receipt token is why you might want to lock CRV up with Curve natively.
Okay. So if I take CRV and I lock it up on Curve, I'm getting the boost, I'm getting these airdrops, and then you get this receipt token, and that is veCRV, right?
Yes, you're getting boosts, airdrops, and half of the fees that are generated. Yep. And you get veCRV, which is essentially the receipt token for CRV. But the way that they do it is essentially that veCRV, little ve, big CRV, is immediately locked up in Curve, basically, is how it works. Like, you're not actually given that into your wallet, because otherwise, as a transferable token, you're not given it. Because then people would create a secondary market, and then in effect, that CRV is not locked, which is the functionality that Convex and Yearn offer.
Okay, so you cannot sell or buy veCRV like on Uniswap or whatever. Okay.
Correct. So you would have to. This was a problem. We were talking about it in some of my discords, where, in theory, we were thinking, well, you could lock CRV, have the veCRV accredited to your account, and then you just sell your MetaMask account or something like that. Maybe there would need to be some functionality for that, because that would maybe be the only way to liquefy that value. But now we have other options, but we'll get to that.
And then if I have veCRV in 1 year or 4 years or whatever, does it just kind of like automatically get airdrop back into my wallet, or do you have to unlock it like you would unstake a token on some other protocol?
Because we haven't gotten to that yet, I'm not 100% sure. What I would assume is that there's a claim function that opens up after that many years, but it could be an airdrop too. But I would just guess that it's a claim. That way the gas fee's on the user, and they don't have to pull that from anywhere.
Got it. Okay. So then the next one I think we should hit is the Yearn locked CRV, right? So if I take my CRV and I go and deposit it on Yearn, what is that token?
Okay. And real quick, I do want to say CRV, because if we're talking about CRV natively, I think there might be some people who are looking at all this and they go, oh, CRV is going crazy. All of this is good for CRV. And you're right. However, does that mean you should hold the CRV token? Just buy it and hold it. I don't know that makes sense as a strategy. It could. But again, there's a lot of dumping, and we've been talking about that, where people dump CRV. So essentially the value is to be farming with it, not to be holding the token. Now, it could be $10 by the end of this year. It very well could be. I have that as part of my projections. However, I wouldn't take that risk. I wouldn't just buy CRV personally and just hold it. I would be staking it. So then, to get to your question about Yearn, when you stake CRV with Yearn, you're given a receipt token that is, let me make sure I get the acronym 100% correct.
It's yveCRV, right?
Yeah, YE. I mean, like YVE dash CRV DAO. Yeah,
Okay.
that's the whole name of it. But I think when people abbreviate it, usually they just do YVE CRV.
Okay. Yeah, it's funny. I sent out a tweet to promote this podcast, and as soon as I realized I had like gotten two or three of these token names wrong. So I
I
apologize.
saw
I
it.
apologize to
Yeah,
everyone, but it already gotten some.
I saw it, but people had started retweeting and liking
So
it.
yeah,
Right?
my bad. If you say my bad, no one can call you out on it, right?
Yeah, no, you're good. Yeah, that's 100%
That's
covered.
why we're putting in the work right here, right? Okay, so yeah, so
Yeah,
YVE
yeah.
CRV. That's if I've locked my curve into Urine, right?
Yes, correct. That's your receipt token for that.
And that is unlike veCRV. That is permanent, right? You're never getting that back. You're locked in there forever, right?
Correct. However, it's transferable. So that's the trade-off. That's the trade-off. Your receipt token is transferable now, but your CRV is locked forever.
And so we've talked about peg, right? So that should theoretically trade about the same as curve locked in governance in their DAO, or should it be at a premium because it's transferable now?
So this is a bit of game theory that's still working itself out. In my mind, these receipt tokens should be worth more than CRV. And that's a bold statement. But in my mind, these actually should be worth more because when you think about it, they are entitling you to everything locking curve CRV up with curve natively gives you, plus performance fees from the liquidity that's farming on these protocols, Urine and Convex. So it's a value add to have that token. So to me, it actually doesn't make sense that these trade below value except for in one general circumstance, which is if I am in cvxCRV or if I am in yveCRV and I'm making these dividends, that's great. I love it. And then a farm launches tomorrow that's paying 1,000,000,000% APY, as some of these crazy farms are. And if that's something that I want to be involved in, and 1,000,000,000's an exaggeration, but I literally saw one for like 3 million the other day on Polygon. So if that's something I want to be involved in, maybe I decide I want to liquidate my receipt token and I want to go take that liquidity and go play on one of those farms. So I think that the scenario where these things break peg is more a sign that there are opportunities for greed and short-term gains elsewhere. So when the market is expanding, I would expect these things to be somewhat off of peg. And when the market's contracting, I would expect them to actually be worth more than CRV itself because you're entitled to additional yield on top of everything that CRV locking normally would give you. So that's kind of the ebb and flow.
Cool. So then CVX CRV is the last one. That is the locked curve in convex, right?
Correct.
And what is everything that you get with that? What's the case for that one?
So with CVX CRV, you get the fees from trading on curve paid in 3 CRV, which is a dollar stablecoin that represents the fees that are earned. You get paid the CRV rewards from liquidity for that specific asset, cvxCRV. It's 10% of all the earnings of CRV from the liquidity, so on convex. So the 3.7 billion on convex that's farming curve, 10% of all the CRV rewards that they make, that keep in mind you're helping boost with your locked CRV, 10% of that comes back to you in the form of CRV rewards. And then 10% of that comes back to you in the form of CVX rewards. So it's 10% of all the CVX that's being earned, as far as I understand it. And CVX is minted as CRV is earned. So again, it's getting kind of hairy, but as the liquidity providers earn CRV from farming curve, CVX mints. That's how CVX is minted. It has a function that's algorithmic that mints depending on how much CRV Convex is earning. So if Convex is earning a lot of CRV, a lot of CRVX is getting minted. And that also is a ratio or a percent that decreases by, I believe it's 0.1% every 100K issued of CVX. So coming back to the original point, for CVX, you get the fee rewards, you get the CRV rewards, you get the CVX rewards, and that would be the additional thing that you don't get anywhere else. And then you also get any of the airdrops. So far, we've just plugged in the EPS airdrops, but I'd assume that they're working on the other ones as well. And again, that's why I think that it makes sense that that thing is valued more than CRV, because it's everything CRV is getting plus the CVX rewards at the very least, if not considering the 10% of CRV rewards coming from the liquidity providers.
And yet, is that trading still at a discount to CRV, or is it?
Yeah, it has been 1-to-1, almost on the dot. It I think at lowest maybe hit for a second like 80%. As the market's fluctuating right now, it's ranging really hard. So it kind of goes between 95 and 100% is what I've been noticing. But it's still so early. I mean, we're really early on it. But what I anticipate is when you look at, for example, when you look at Yearn's yveCRV, it's currently trading at 174. Let me refresh the page. 174. And CRV is currently trading at 226. So 174, 226 is 77%. So Yearn's receipt is currently trading at 77% of CRV. Convex is currently trading at, I won't do the exact percent just because for the sake of time, but it's been between 221 versus 224. So that's, shoot, let's do it real quick.
Pretty closer.
It's 97.8%, so 98% basically. And I think the reason being because that receipt is much more valuable because it entitles you to more than Yearn's does. But again, I think both of them theoretically should be above the value of CRV in a contracting or fearful market because it's more valuable than CRV in just the benefits. Gives you everything CRV gives you plus more. So I think that's the way it should be in a contracting market, and we'll probably see things trend that way.
You think all things being equal, probably the better play is cvxCRV because you're getting all of these extra rewards on top of it, plus CVX.
I would say that's my play. That's when I first started, I had a portion in CVX as well. Right now, I'm 100% cvxCRV for what I'm in Convex for, and I intend to kind of start stacking CVX as the pool APYs even out. I know I've been talking a lot about that on Twitter because there's a lot of factors, but it really does. When you eat all factors considered, it's as simple as if I'm earning both CVX and cvxCRV, and one of the pools has a higher APY, I'll sell the other one for that and deposit it where the higher APY is. It really does kind of break down to that simple of a factor. So as those pool APYs, I expect them to just trend basically even, more or less, for probably the entirety of Convex existing, which, I expect those to trade relatively even. At that point, that's when I'll start investing more in CVX, and then just selling on hype waves, because I think some people will not understand that, and they'll just go, oh, Convex is huge, it's blowing up, and they'll buy it, psychologically, not understanding that people are going to be dumping it as long as the APY for that pool is lower. And as the price of Convex goes up, this is helpful to explain. As the price of Convex goes up, the pool APY goes lower. Just nobody has to withdraw or deposit or anything because it's in dollar terms. So the same amount of cvxCRV is being given to the CVX stakers, but if the dollar value of that pool goes up because CVX goes up, then the same amount of cvxCRV is being issued for a higher dollar value of pool APY goes down. So I think that they'll trend even, and when they don't, that's an opportunity. And right now the opportunity
Or
is in
even to arbitrage between them.
yeah, exactly. And so right now the opportunity is cvxCRV because the pool's higher.
Okay. What about the Cvx token itself? Like, what's the utility there as a underlying? Like, is it accruing any rewards or underlying protocol fees, or is it just strictly a governance token?
Well, that was my initial concern when I got into this, and I was talking with a lot of people that I'm involved with. We were thinking, this thing could go to zero, and it was mooning, but we're like, this thing could go to zero. And if it does, what happens to the entirety of the protocol? And so I ran a bunch of math and hypotheticals with that to find out. And the way I see it, essentially, even if that thing went to zero, the cvxCRV pool still has considerable APY, probably between 30 to 50%, just off of the performance fees of the liquidity that's on the protocol. But there's a lot of factors to that. There's so many factors. I was just trying to give myself a general bottom line, but I don't think it'll go to zero for two reasons. One, you're earning a 5% performance fee by being in that pool. So 5% of all the liquidity, their gains, the 3.7 billion, their earnings, 5% of that goes to CVX staking pool. And we understand that liquidity on Convex is sticky in the sense that to some degree it will always be there because there will always be CRV locked up with Convex. And if there's always CRV locked up with Convex, there's always a boost to be had to deposit liquidity there, farming Curve, which means there's always an advantage to depositing there over depositing on Curve, to a certain degree. And so there will always be a performance fee. And if there's always a performance fee, then there's always some value to that CVX pool. And so there's value to CVX. That's the simplest mathematical way to say that there's value in CVX. And then the other way to say it is, or the other reason is what they're working on implementing that they've confirmed through their Discord and Twitter is that you'll be able to use your locked CVX to vote on the gauge weights with Curve. And that's another thing that we didn't really talk about. But essentially, Curve stakers get to vote on which pools get prioritized for APYs, for rewards, for Curve rewards. And the reasoning is actually integral. It's not just arbitrary and to let whales control where the rewards go. It's because this is essentially a foreign exchange market in the aspect that competing protocols and chains and etc. issue their own stable coins, and they have different mechanisms for which they stabilize them. But if a new farm comes out that uses USDC, well, now there's a ton of demand for USDC. Well, we want to incentivize liquidity for USDC. So it's kind of they vote on this every week, and so it's allowing CRV stakers to say, hey, what do we need liquidity for? And then we can incentivize it with CRV rewards. And that's flexible on what's happening in all of crypto, depending on what farms are popping up and etc. So the power to affect those distributions of CRV rewards, it appears from everything they're saying, is going to be given to the CVX holders. So that is an additional value above and beyond. And the game theory of how that affects the price, we'll have to see.
That's really interesting. So you could almost think of it like like an activist hedge fund. Like Convex is this fund that accumulates a bunch of shares of CRV and then is able to kind of vote in governance or kind of like influence it one way or another in a way that would benefit those initial holders, right? So like they're having more of an active voice in the governance going forward in a way that would be more aligned with the Convex. If you're on Convex, you have that like almost proxy vote in Curve.
Exactly. And that was always one of the arguments for Urine too. And one of the worries was Urine is acquiring so much of the share here. They're a massive voter and they could just swing votes here to however they want. So again, decentralization. And it's so good that Convex now is essentially another, it's that problem with Bitcoin and mining where we say we have all these mining pools. If they acquire so much, they could vote the mining pools could effectively change the chain. They could get that 51% attack a lot easier theoretically, right? So that's why we want decentralization. So what these are essentially curved mining pools. Convex is a curved mining pool. Urine is a curved mining pool. And so the more that we have, the better, I think, actually. And it will happen that there will be more because, like I said, as CVX rewards go down, it just makes sense that somebody else pops up and does this same thing of what Convex did to Urine. And so there has to be conversation for that to happen in a decentralized system. Because the whole point is that there's no centralized party making unilateral decisions like that. So they say, and they may have inside info too, right? Like someone in Yearn might say, hey, there's this farm's popping up next week that's going to have, USDC as a pair, right? For instance, there's right now Iron and Titan on Polygon that's going crazy right now. It's the hot farm. There's a little bit of alpha to put in there for people who don't know, and that's the hot farm, and they're using USDC pairs. So we know we're going to need a lot of USDC liquidity. So let's gauge vote to make the USDC pools, the 3 pool, etc., have very high CRV rewards, so people will put liquidity in those pools to help those protocols balance their books, which is really Curve. Curve will be used by individuals, but I think really Curve is going to be used by whales and big protocols, like something like Synthetics. I don't know that Synthetics is the one to figure out synthetic stock trading, but whoever does is going to make a lot of money and be huge. And when they do, it's the essence of like, all right, I'm a rubies guy, I deposit rubies into Synthetics. Somebody else is a sapphires guy, they deposit sapphires into Synthetics. One of us wins betting on Tesla, and so there's rubies and sapphires, but maybe the sapphire guy won and he only wants to take sapphires out. So now Synthetics has to balance their books. Well, when they're doing that, it's a big trade. And so they have to go to Curve and swap rubies for sapphires or USDC for USDT to make it practical or to this market. But that's really who's going to be using Curve, is protocols that need to make massive swaps for reasons like I just described.
Well, I mean, this is like such a super multifaceted question, and the one thing is like we're completely in early days. Like this conversation with the governance, I think, is super fascinating, right? To see how these kind of like sub pools of governance work out and can swing their weight around on these larger protocols, and how that's going to play out long term. But is there anything that we haven't covered about this dynamic that you think deserves to get a hearing here?
I think we covered the pros and cons for using each of these and what their coins are and do and how you can use them. So I think that's a huge part of it. I think that people, when they're trying to like run hypotheticals and think this out with Convex specifically, should kind of look at the rewards that are earned for each of the pools and kind of just think that out and think how you think that might go. I have given my opinion kind of, but for the CVX pool, you earn cvxCRV. For the cvxCRV pool, you earn CVX, CRV, and 3CRV. And so as those are volatile assets that you're earning on, how do the changes in those volatile assets change the APYs of the pools? And why would those assets change in value under what circumstances? And I think that's just an interesting line of questioning for people to kind of think out. And again, within the ebb and flow of contracting and expanding markets in general in crypto. Is the general market expanding or is it contracting? And then how does that affect people wanting safe farming?
Well, cool. So, I mean, the last thing that we kind of got into a little bit earlier, but I wanted to come back into it, is this question of inflation and how this kind of plays into the crypto ecosystem, right? Because like there's this kind of the core Bitcoin narrative is that the Fed is creating inflation, and that's destroying the value of the dollar. But then here, we have all of these crypto protocols, and we've seen like with the Urine case and the Convex case that you've made the argument that being able to create this inflation in their native token is really the core advantage that Convex has over Urine now. So how do you see, number one, like inflation in the stablecoin markets? Like, are we reaching a point where all these new stablecoins coming out, some that are algorithmic and are creating value out of thin air that are not backed by any actual dollars? Like, how is that gonna hit the macro? How inflation works? Like, if crypto gets 100 times bigger, is that gonna change the way we think about inflation? And how do you think about inflation when you're talking about these protocols who can come up with their own token? And is inflation actually like is it a competitive advantage in that case?
I think that inflation is relative. Like, really, what the crypto movement is doing, I think, is organizing systems of value. So, like, and relativizing them all. So, how is this pencil valued relative to this coffee cup? And I'm just picking things in front of me. And we have dollars that we use to represent that relativization of the value. And so what we're doing is we're creating tokens to represent the value of systems. And systems could be people too, and things like that. So I think that's where BitClout is kind of ahead of its time. And I know it gets a lot of shade, but then you're going to have influencers who have their own tokens who show the value of the communities around certain influencers and around everything. Everything has a relative value and could be compared to other things. And so then inflation comes in and says, well, if everything's referring back to the dollar ultimately, which is how it's been on the macro scale in the world, and the dollar is losing its value, well, the dollar still could be going up compared to the Great British Pound or the the yuan or whatever it is. The dollar could still be going up even though it's getting devalued, because maybe it's getting devalued less. Maybe they're devaluing their currencies more over there. So it's a whole game of relativity, which is why I think in crypto the trend is things like the bank protocol and the Ohm and Ohmies, because they are trying to establish a peg to, and all the algorithmic stablecoins, they're just trying to establish a peg to one, the unit of account one, not necessarily $1, or not even one with some of these protocols like Ohm and Bank. They're just establishing a peg to some wherever this system tends to level out. And I think that's valuable because then you can start comparing the dollar in terms of these things and their inflation schedules. Because if you're losing your value of the dollar at some rate that is very hard to measure, but you can let the market decide that maybe it takes $2 to buy one USDC or one DAI in the future. And I think that's kind of where we're headed as the market starts to make its psychological decisions on how many dollars are worth one DAI based on what the perceived inflation of the dollar is. And so I think that's where we're headed. And inflation is a very important topic because, yes, Bitcoin, I think it was the thing that got this all started, and it's so important because there's nowhere else that you have such certainty in scarcity that you can feel confident in a store of value. And ETH's trying to challenge that with 1559, but there's nowhere else, I think. Gold is where people have historically said that you can do that, but still, there's how much gold's being mined. How do you know? Who's mining it? Who owns the mines? Are they storing some somewhere you don't know about to release later? There's so many questions, and with blockchain, we're able to verify, not trust, right? And so there's a tendency to go into this, I think, for a lot of people and think, well, inflation is bad then. And that's I think that's not the best way to look at it. I think that inflation, it's not good to have inflation and no store of value. Once you have a store of value, you only really need one of them. And then everything else can be inflationary, and there's value in that because this is I like to think of it like the the storming of Smog in his mountain, and the in the Lord of the Rings and the Hobbit, and going to Smog's cave and getting the gold that he's hoarding. And the reason why we have myths like that, I think, is to show this kind of principle, which is, all right, if really the dollars are or the whatever it is, seashells, dollars, gold, is representing human labor in the sense that we're getting paid for our labor in these representatives of our labor. And then that representative thing is just stashed and dragon hoarded away somewhere. Well, then we're essentially wasting human labor. And I think that's the most fascinating way to look at the benefit of inflation, is to say, well, inflation discourages dragon hoarding. Inflation discourages people from just holding human labor hostage and forces them to release it, because otherwise that stored labor is getting devalued because there's inflation against it, right? Um, so that's the benefit of inflation. That's why I think for all of these productive systems, you want inflation for as long as you can have it at a predefined and determined rate that's transparent and that everyone can see, so we can plan for it, which is not what we have with the US dollar. We cannot plan for the rate at which the Federal Reserve is going to inflate it and how they spend it. However, with these systems, we can say, hey, curve is inflating at this rate. The rate changes like this. It's paid in these ways. And how is it paid? It's paid to people who are providing value to these systems, which is why I said don't just buy curve and hold it, because you're going to get inflated against. And it may work out for you because we're in the explosive phase of adoption of these things. And so the curve price might go up from $3 or $2 to 10, maybe. But it's more valuable to put that thing to productive use so you earn and don't get inflated against. And that's what we'll see play out as this explosive adoptive phase starts to turn into more of a stable usage phase, as more and more of these things reach their critical mass. It will really not make sense to just be holding these assets. You will have to be putting them to productive use. And I argue that that's good for society, because it forces these stores of value to be put to new productive use, as opposed to just letting the labor that created them fizzle and be wasted.
I think that makes a lot of sense. And I mean, like, the other way to look at it is, like, as technology improves, the sort of sum of value that's available in the world goes up too, right? So now we have planes, we have electricity, we have factories, we can produce more stuff. Like, the currency has to inflate to keep track of that expanding value that's coming with, like, human ingenuity, right? And, like, having it seen as that system, like, you know, inputting dollars to make new stuff, to make new technologies, to increase everyone's utility. That has to have, like, there has to be some way of capturing that upside, right? Or else it's just this one lump of gold that everyone's fighting over for the rest of time.
Yes. Yeah, that makes sense. And I think it's a very similar point to what I made. You know, like, you're rewarding that ingenuity with the inflative rewards, and so that's what we're doing. Like, you know, in Urine, you come up with a good well, that's not a good example because they don't pay Wi-Fi. But if they did, you come up with a good strategy and it gets implemented, you get paid in Wi-Fi. You know, for coming up with that strategy and advancing the tech per se, right? Coming up with planes from riding around in Model Ts, and there's a reward for that. And it's transparent and algorithmically defined.
Yeah, I mean, I think that was the second kind of, like, point in my earlier ramble that I was trying to get to, is, like, that if your token is finite and emitted in this blast, then you're kind of at a disadvantage because you can't, you know, you don't have that inflation to play with and use as a reward. And
Right. And so now Wi-Fi becomes a dragon hoarding tool, and that's no good. I think that it's interesting. I have this idea of what they might do, and I'm just throwing this out there into the ether. But you know how we have, like, Class A and Class B stocks. One of them are voting, one of them are non-voting. Well, what they could do is issue a new token that's a Class B non-voting stock, so you don't get governance rights with it, but it is, and it earns some percentage of the performance fees from Yearn, that gives it, you know, some inherent value and not just as a belief token. And then that thing is issued over, you know, a long term, like 300 years, like CRV. And that's paid out as rewards within the Wi-Fi ecosystem. So that could be an answer that they choose to make, because I think they have to do something. I I think they'll grow regardless, because them as a DeFi hedge fund, the talent that they have in their developers, the community that they've built up, there is absolute value in those things, and so people will want to put money in Yearn. But within the with the open source nature of crypto, anything that they do could be copied by another protocol that's giving incentives. And so the route, Uniswap's taken is Uniswap. I actually kind of I personally look a little down on in some respects, because they went against the ethos of crypto and kind of closing their code and doing things like that. And I understand why they did it, because you put so much time into coming up with this stuff. And then, Curve came out recently doing the volatile asset pools, and they showed you their math. Not that you're going to understand it, or that you might have to take a graduate math course to get what they're doing. But if you want, you could copy it. You could take the time to figure it out. I don't know if you've seen that white paper, the 5-pager that came out for the V2 curve.
I did look at it, but just in the sense of, people posting on Twitter how complicated it is, and how no one understands it. So I didn't really,
I gave it a good half hour, and then I was like, enough to feel like it's not gibberish, but not enough to understand it at all.
Right. Yeah, I mean, that's the other thing. We were talking earlier, one of the kind of narratives of DeFi is oh, it's code, and anyone can look at the code, but how many Solidity developers are there that can actually audit this stuff? And the people that are auditing, that's not a guarantee of anything, right? So that's why I like having conversations like these with people who, it's basically a full-time job to understand even one of these protocols. I would encourage you, we've only just scratched the surface of this. I'd be happy to record another one of these, or you should go start a Substack that's just exclusively on these, series of questions, right? Because it's such I think that's the way things are going to be going. Someone's going to make a niche for themselves as the Curve daily email guy, or the Curve daily podcast person. There's just so much nuance and all the governance questions that come up each week. It's really more than a full-time job for someone.
It is, and there's so much of a niche for that, for being able to be a bridge, and that is the role that I want to function to some degree, and I'm just figuring it out, because I think that you see this too with wanting to maybe start this podcast and kind of taking some steps towards it, is and I've seen this in other areas of my life, where you commit yourself so fully to something, and you burn out, and I think there's something to be said for taking your time with it and letting your interest in what you do build as it naturally wants to do. And so I've created accounts on other subject matters and things outside of crypto that I've gone really into, and they're things that I like, but I call it kind of being the dictator over myself, and forcing myself to do more than what I feel like doing, and then when I do that, I then end up resenting the thing, and so it's taking my time to be involved in it with what feels right at the moment, and so it's escalating, and this podcast was a step towards that, and I really appreciate you having me. It was a step towards doing more, and it felt right at the time that you asked. And I'm posting more on Twitter, more and more, and feeling really good about it. I really, really enjoy being able to, help people understand all of this, and do something with all the time that I spend in this, other than just make money, because it's not ultimately fulfilling. Anyone who's made any portion of money will tell you it's not fulfilling, and you might just go for more to try to make it more fulfilling, by buying a bigger boat or a bigger house, or etc. But I think most people understand that fundamentally it's not rewarding in and of itself. You have to do something with it. And so with spending 9 to 12 hours a day researching this stuff for the past 9 months, that's been the frequency, and that came naturally. I didn't force myself to do that. I was just that interested. And like you said, I mean, still, I have things came up today. I have questions I don't know about, and you would think 9 to 12 hours a day just researching for 9 months, you should pretty much be able to understand the whole space, but you just still get a sliver, because there's so much going on, and it's so there's so much.
Yeah. And I think I can kind of feel this, the crypto ethos of if you believe that this is going to be the next financial system and this is what we're building here, then it's really all of our duty to get people on board and have these really basic conversations, and educate people like me that don't know what they're doing, and teaching about this stuff, because it's not simple. It's very difficult on a number of levels, and like the game theory level, the knowing what's going on in protocols level, the knowing the technical stuff and coding and learning Solidity. Like there's a lot of work to be done, and it makes sense to leave a ladder down for the next group of people who are coming on board. So thank you. I know we've gone a long time, and I need to pee. So let's just wrap up. So what other projects do you like? Like, what are you looking at when you're not looking at Curve?
And real quick, let's put a feeler out there, because within that thing that you last said, I agree. I want anyone who's a Solidity dev who understands this stuff, like, please reach out on Twitter, because I have a very, again, bridging. I have interest in trying to help people understand the code more, and myself understanding the code more, and being able to kind of like, I know you're kind of forming a little research thing, unit of however that ends up expressing itself and manifesting. But, and I'm in a similar place. So a very valuable asset would be someone who understands Solidity and can help bridge that gap for our knowledge and for other people's knowledge, to help get that out there, and try to, like you said, the audits cannot always be trusted, and we just need more people who understand the code to help bridge the gap of understanding. And as for projects, gosh, I was in so many things earlier this year, and I think that when the market's like really churning, that's maybe a good strategy. If you have high conviction, as I've had high conviction on Curve for a long time since it came out, and I still wasn't very heavy into it because I saw it as the stable long-term thing, and I wasn't trying to play that game yet. I was trying to play the short-term game. So you have to be like aware of where you're at and where the protocols you're involving yourself in are at. And so I know Aave was a big investment for me at a time. I've gotten into some smaller, like a lot of NFT systems. That was something that I really got inspired towards, because I had the fortune of getting involved in hash masks. I bought 5 of them, just kind of said, these are cool, whatever, let's see what they do. And that ended up being, a 5x investment. Wow. And it started NFT season. And so, after that, I was like, NFTs are so cool. And I have now made maybe the most money total on NFTs of anything else, because I had this early win and it got me excited, and I do love art. I've always loved the artistic side of things. My mom's an artist. And so, I've really had a lot of fun with NFTs, and not just NFTs, but their systems. I invested in the systems behind them. And while everyone was investing in NFTs, I did a little bit of that, but I did a lot of like Muse. I rode Muse from 90 cents. It went up to like 120 at the height. Like things like that, because it was just systems, and I saw like, here are all these NFTs and the systems are just getting started, and so I'm a systems guy, so that was cool for me. And so as to now, I mean, Badger, I know you're from Badger, that's maybe your focus of understanding. I'm big on Badger. I love Badger. So I'm still invested in that, but I have moved most of my funds to Convex, because to me it aligns my short and long-term incentives, or horizons. Like I know that, or I believe that Curve is going to be a very long-term protocol, and I'm going to benefit from being there long-term. And now with Convex, since it's so new, it's a very good short-term opportunity I see as well. So I get to align my short and long-term incentives. So I went almost 100% in as soon as I understood it and had done all my research and hypotheticals. And then the other 20%, so I'm saying if this is like my real long-term, just making an APY more steady, I've taken 20% and I'm playing around with some of the riskier stuff, because I have fun with it, Like I just got into Polygon. I don't do Binance because the crypto idealist in me has some gripes about that. But I got into Polygon just now, and I've been playing around with some of the silly farms on there, and it's just fun. It's just fun. Whether or not it actually does something significant, is yet to be seen. But that's right now. I'm pretty much 100% Convex CRV. So
Awesome. Yeah, I'm a big proponent, and this has been a real change in my investment style. Like I used to be quite conservative, and then I was reading some stuff, and like the kind of like never lose money, don't forget rule number one. But then, if you're in this world where technology is changing so quickly, like you absolutely have to have like an R&D fund, like some percentage where you're just putting it into the wildest shit, like the newest stuff, just to see how it works, right? Because
yeah.
like with crypto, it's there's so many new things coming out, like you just have to play with it and be early on stuff, right? And so I was happy to lose some money on some scams. Like that's probably like the best tuition in all of crypto, right? Getting rug pulled and finding out how these things
Yeah.
work.
You have to try. You have to, because it's different than theorizing. It just is, and we all know that. But yeah, I love all the opportunities I've lost money on. And obviously in crypto, like you said earlier, you may only need one winner. Likely you'll have many more, but uh, it only takes one to offset the losses of many others. Um, and another, you're talking about changes in investment strategy. Before I got into the crypto groups I'm into now, the discords and etc., I I was much more conservative in new opportunities, but I noticed some of the best guys, the apeage, and
Mm-hmm.
that term, aping in, it is a powerful thing, and it's obviously something to be done with a lot of consideration and awareness of the pitfalls, but I've more switched to a strategy after seeing what so many people I know and am associated with do. Is I'll almost put money into something, not maybe the full amount I might, but like some amount into something, just right when I see it and it feels like a good idea. And I have that intuitive kind of like, this may be big, right? And then that investment forces me to do more research. And then I may invest more or I may pull out. But I get my foot in the door first, because not only could things move so fast, and the likelihood is if something triggered me, whether it was a Twitter post or whatever it was that got me looking at that protocol, the odds are there are other people that the same thing happened to. And so if I could get my foot in the door early and not have to do my research first, the odds are that might be a great bet, at least in the micro short term. And then I do my research and I say, you know what, I want to pull it out or I want to put more in. But getting that foot in the door and just kind of going for it, there's something to be said for that, with obviously some risks and caveats attached.
Well, crypto idealist, dude, thanks so much for taking the time. This has been really fun. Hopefully, we'll do this again sometime. But thanks so much for your time and for sharing your knowledge on this.
Thank you, man. I very much appreciate the opportunity. It's been, like you said, it's been fun, and I it's exciting. I've always wanted to go on a podcast and kind of do that thing, and I've always wanted to start one myself. So this gives me a little inspiration. And yeah, likewise, I'd love to come back on and talk about something else.
Absolutely. All right, take care.
You too. Thanks, Wasabi.